All right, I think we're good. I never know for sure. Anyway, this is going to be a market update. Now, every year we reshuffle all of the companies that are in our basket of stocks that we can purchase. And I'll show you just really quickly what that looks like. Just a moment here. Now, keep in mind, I've mentioned this before, but I'll say it again. We only invest in big cap, mega cap companies that pay a consistent dividend for at least 10 years. The companies also have to be in business for at least 10 years, okay? And so when I say mega cap, I mean the biggest of the biggest. We also invest across all 11 sectors of the economy, okay? So when I talk about 11 sectors of the economy, I'm talking about basic materials, which is going to be, you know, like Weyerhaeuser, the company we were in before, which was lumber, but there's copper, there's plastics, there's, you know, basic materials, things that you use to build, okay? And so what we do is we go through the market and we find the biggest of the biggest companies paying at least a 2% dividend. And again, they've had to pay that dividend consistently for at least 10 years. Otherwise, we don't even consider them investable. Okay, so this year, this is the list of the companies that we have in our basic sector. And I'm really excited about that because last year we only had like 3. So this year we were able to add a few more to the list. Let's go down the list here. Our communication services, these are going to be your cell phone companies and whatnot, Verizon, Rogers Communication. I think this is British Columbia. This is an old AT&T company that's now in Canada. TLK, AT&T, of course, and then Telus. And then what we do is we track these companies, okay? We track these companies, we score them, and then we put them into these portfolios. I'm going to blow this up so you can take a look at it, all right? And then what these portfolios do is, this is just a good example. Let me refresh this thing. This is just a good example of what the portfolio looks like, okay? So these companies are scored for having the highest dividend, all right? So for the industrials, this company has the highest dividend of all the industrial companies. You know, this company has the highest dividend of all the communication services, okay? And then what we do is we go back to July of 2019 and we assume that we purchased all of these companies, okay, for a total of roughly $5,000. Okay, you see that here, total cash $49.87. We assume that we have that much money, and we purchase all of these companies. Okay, July 2019, and then we monitor their performance over the course of time, because not even gonna say a year. It's been more than a year now, and we see what their performance has been. Okay, and so you see here, this is the purchase price. Again, that's as of July 2019, and here's the current price, okay? So you can kind of see exactly what has happened with all these companies, all right? And then when you come down here, and I usually have this highlighted. Let's see if I have it highlighted. Yeah, there we go. You can see what the performance has been, okay? And you see this a negative almost 11%. So the dividend portfolio has not performed very well. Now, this is going to give us all of the performing portfolios, okay? So, again, this is going to be as of July 2019, okay? And so what we're looking for is we're looking for the best performing portfolio since July 2019. And you see it's been the return portfolio, the return standard deviation, and return alpha, all right? And I'll talk a little bit about what these words mean. So return is going to be based on an average 1 month return. So this is going to be over the last 12 months on average, these companies returned or performed the best over the last 12 months, okay? Return standard deviation means that we split the score. So it's going to be 50% based on a return score, 50% based on standard deviation. And standard deviation is a statistical term that basically talks about how much these companies move around as far as performance goes. So if you have a company that's down 5% one month and up 5% another month, that's going to be a high standard deviation. So we are looking at companies that don't move around a whole lot, right? We don't want them to go too far down. We don't want them to go too far up, okay? Alpha is, now I have to specify here, if you go and Google alpha, that's not the same thing for this particular software, okay? This software is calculating alpha as companies that perform best when the market is performing best. And remember, our benchmark is the Dow Industrial average, the Dow Jones Industrial Average. So when the Dow Jones does well, right, for the month of, let's say, December, right, these companies also do well for the month of December. If the market is doing well and companies are doing bad, then they have a low alpha score. If they're doing well when the Dow does well, then they have a high alpha score. And so you see this score is split between return and alpha. Beta is going to be the exact opposite of alpha. Again, not what you would find if you were to Google beta for statistics, okay? This is companies that perform well when the market is not performing well. So if the Dow Jones Industrial Average loses 5% for the month of December, these companies will have gained maybe 1% or 2% or something like that. And so what we're looking for are the best performing portfolios most recently, right? So again, we see a quick list here. All right, this is going to be the best performing portfolios over, since July 2019. All right, so let's look at the last 12 months. Okay, this is going to be a rolling 12-month return, and we see that return and return standard deviation is still top of the list, okay? We do see a few differences here with beta, return standard deviation, return alpha, things of that nature, but return and return standard deviation is still at the top. Now, this low mark here is the lowest that the portfolio has performed. So in any 1 month, I'm looking for the word here, the least amount that they have lost over the course of a month. So the least amount, the most that this portfolio has lost over, since July 2019 is going to be 8%. And that makes sense because we're talking about a beta portfolio, right? So when the market is doing poorly, these companies are performing well. And so it makes sense that the beta portfolio will be top of the list, right? And you see a bunch of these betas, right? Beta standard deviation, beta up, beta down. And let me talk quickly about up and down. I've discussed this in prior videos, but I'll rehash it just in case. So up is based on volume, okay? So volume is how many people are buying and selling this particular company, okay? So what I do is I take an average, or what the software does is rather, is it takes an average of the volume that this company has. So every day they have maybe 2 million shares are being traded, right, on average, okay? And so the question becomes, what happens when there's more selling or more buying? So if the average is 2 million a day, what happens when all of a sudden you have 4 million shares being traded, right? Does the company go up or does the price come down, right? And so if the price goes up, what that means is that when there's more shares being traded, this company tends to perform better, which means you have more people buying than selling these particular companies. And down is going to be somewhat of the opposite. It's whenever you have lots of trading going on with these companies are going to lose less money, okay? So when there's more selling, they're losing less. So up is when there's more buying, they make more, and down is when there's more selling, they lose less. A lot of that really has to do with institutional ownership. Okay, a lot of these companies are owned by big banks, right? Like your Fidelities and your Morgan Stanleys and things of that nature. And typically, those big banks don't do a lot of buying and selling, so they tend to the price tends not to move around so much. All right. M score, that's kind of important to mention. This is um, a new attribute that was only instituted maybe I want to say last year or year before last. And what this does is this calculates the management score of the company, right? So all of these companies have managers, they have CEOs and presidents and whatnot. And so what we try to do is we try to score how well these companies are being managed by looking at the fundamentals. Fundamentals are things like how much cash to debt does a company have, how well are they managing their assets, which means return on assets and things of that nature. I have to say that over the last, I don't know, 2 years, maybe 2.5 years, the companies in the M-score portfolio have not performed well at all. So at this point, I don't know if that's something to look at or not, but it's there nevertheless. We've talked about dividend already. I think that's really about it. We talked about standard deviation. So anyway, so again, these are the companies that lost the least over the past, year and a half or so. And then, but I do want to make mention here. So you see the high, right? So this is the most that these companies have ever returned in any 1 month over that same year and a half period. So let's take a look now at the largest returns, and we see it's jumped way up here. So it's 17% for the alpha, 16.5 for return, 14 for the down moves, and that makes a lot of sense. And so what I'm seeing here and what is clearly obvious is that the return portfolio has been the best performing portfolio over the last roughly year and a half. So that is the portfolio that we are going to try and mirror. So let's take a quick look at what that portfolio looks like, and then we can get into a little bit of analysis. So here's the return portfolio. Back up. Here's the return. Went too far. So here's the return portfolio. I keep thinking, how many times did I click? All right, here we go. So here's the return portfolio. All right. And so again, this is assuming that we purchased these stocks back in July of 2019 with roughly $5,000 in cash. And the software tells us exactly how many shares to purchase to give us, the best performing portfolio. And we can see what the performance has been over that time period. So you see Best Buy, we purchased at $70. The current price is now $102. Bank of America, Garmin, Valero, Fastenal. I don't know a lot about SCCO. This is Merck, SYY. BIP is another utility. Rogers Communication, which we're already in, and then UDR. Okay. Now, with this portfolio in mind, okay, what we have to do then is we have to go in and we have to look at, okay, so here's the best performing portfolio. Do we completely sell all of our positions and then go into these new companies? How do we do this? So I go through all of these, and these are my notes, okay? And I also included a few other companies in this list, and I'll explain why here in just a second. But first, we have our financial services, right? So Bank of America is the company in the return portfolio, so we definitely want to check that one out. Blackstone is a company that we're currently in, so we definitely want to see what the difference of that is. And then DFS and HIG are other companies that we were looking at. And if I can find out why. Okay, so this is the performance over the last 12 months. Okay, it's the average monthly return over the last 12 months. Okay, and here's the company. All right, and so what we're doing is we're going down this list and we're looking for financial services, and we see DFS. Okay, DFS is the highest monthly average returning financial services company. Okay, at 3.5%. If we keep going, we'll see BBVA at 2%, and then we have Blackstone at 2%, and that's it. So the other thing to mention here, I'm gonna have to come back to my table, is this MVP category. All right. So this MVP, see, there's a lot of financial services companies. That's another thing. Like I said, every year we reshuffle, and this year we had a lot of financial services companies added to our basket of stocks. So it was quite a bit going through all of these. Now, BBVA, you heard me mention as one of the best performing companies, but the problem is that BBVA is not investable for us because of their dividend. Okay, and I'll show you how that stuff works, maybe in another video or maybe in this one. But either way, even though it did perform, one of the best, it's not investable for us. So Blackstone is kind of next in line, and then we have this MVP column here. And so let me show you what that looks like. So MVP, what this means is that every month, okay, we like I say, we monitor the portfolios every month, all right, and it looks like this. Here's the chart, all right, and what we do is every month we look and see which portfolio performs the best, okay, and so this is December 2020, and we see there's a whole lot of green here, right? And when you see the red, of course, that's a negative return, and then yellow and orange is kind of in the middle. But, the greens are really good. And so in December 2020, I believe the best performing portfolio, if I can find this real quick. There we go. The best performing portfolio was up and down. Okay, so again, this is going to be a score split between companies that performed well when volume is high and companies that don't perform poorly when volumes are high, if that makes sense. But anyway, and that is indicative of a lot of buying and selling going on in the market. And so when you see this bright green going all the way across, I mean, that means the month of December, everybody was making money. I mean, there wasn't a poorly performing portfolio at all. None of these portfolios lost any money. They all did something, right? But the up and down did the best. Now, why that's important is because what we're doing is we're now saying, okay, so if that portfolio performed the best, what companies were inside of that portfolio, right? And so that's what this is, all right? Every month we pull out the best performing portfolio and we look at the companies inside of that portfolio. Okay, and so we keep this on a rolling 12-month basis, but we can go back, we can go back a couple years if we needed to. And it's color coded for the particular sector. Okay, so for instance, the energy sector is going to be yellow, financial sector is going to be white, black is going to be technology, so forth. Okay, so what we do then is we pull it all here, and HIG was on or in the best performing portfolio 5 times in the last 12 months. Okay, HIG was in the best performing portfolio 5 times in the last 12 months. Now, HIG maybe in, who knows, 2 or 3 different portfolios. I mean, there are, um, I don't know, at least 20, a couple dozen portfolios, if not more. Okay. But as you can see, the performance hasn't been great. But just because it was an MVP 5 of the last 12 months, I thought it'd be a good idea to at least give them a look. Okay, and so here are my notes concerning these companies. Now, um, Bank of America has a better alpha, better return, um, and we did check the earnings, and I'll talk about that here in another video. Actually, I'm going to go ahead and cut this one short, but just wanted to reiterate that we are following the return portfolio. Okay, that's kind of what we're looking at. That's where we're going for the next year until July of 2021.